Hey, Facebook and YouTube. I am here live today with Michael Carolina. Michael is the branch manager and mortgage loan officer for residential home funding. And we're talking everything. Typically, we normally talk about purchasing your home, but today I wanted to do something different for our current homeowners. So we're talking more about different options once you already have your home. So we're talking about refinancing. We're talking about HELOCs. We're talking about a lot of different programs and options that you have as a home perks that you have as a homeowner that you could take advantage of. And Mike is just going to educate us on that today. So Mike, could you just introduce yourself and tell us a little bit about yourself? Who are you?
Who am I? Good question. My name is Mike Carolina. I'm the branch manager for residential home funding. We're located here at 5302 East Court Drive in Upper Marlboro, Maryland. I've been in the business for over 21 years. Been with residential home funding for going on 3.5 years. We offer different type of products and programs, which we'll kind of go into. And my position is to educate and promote home ownership as well as any type of mortgage transaction one may be interested in.
Okay. So what I'm doing right now, excuse the echo, and what I'm doing right now is trying to share our video to your page and my page. So you could just share just a little bit about refi. Tell us, I'm gonna ask you a question. What are the different type of requirements between refinancing and an original home loan?
Well, there's really two types of transactions. Your purchase transaction, that's for whether you're looking to do a purchase transaction for primary residence or an investment or maybe a second home. And then you have your refinance transaction. Your refinance, that can be just what we call a rate and term. And then you have your or no cash out. Then you have your debt consolidation where you may want to pay off certain debts that you have, and you want to just kind of roll them up into one and just have one payment where we're pretty much offsetting the debt, such as credit card payments, car payments. We'll pay those off, and then you just factor that into your mortgage, hopefully taking advantage of some of the low rates that are out here now. And then you have your cash out refi where you can take out cash and do what you please as far as maybe taking a trip, paying off your children's college loans, or you can do what we also have is a refinance loan where you can use that to do some rehab work to your home.
Okay, so oh, I'm sorry, y'all. It's always an echo when you're on a Facebook app. Give me 1 second. I apologize. Uh, what that makes sense. So when you're are the loans been or the qualifications looked at differently? And this is off the fly based off of some of the stuff you talked about. When you're looking to consolidate your debt or versus you pulling out cash, do you guys look at the requirements differently? Like I mean, if I wanted to refinance my house and consolidate all my debt, would like my debt to income ratio at that point be considered for that loan, or is that something that is more, I mean, easier to obtain because they know that you are trying to eliminate some debt?
Well, and that's a great question, actually. We have to consider all factors. I mean, this is an investment. We want to try to minimize our risk as a lender as well as minimize the risk for a borrower. So whether you're looking to get qualified for a purchase loan or refinance, there's different measurements that we must take to make sure that it's a net tangible benefit to you as the client. It has to benefit you more so than us. But there are guidelines and programs depending on, again, whether you're purchasing or buying. We still have to go through the qualification purposes. So to address your question, we do check for credit. whether you purchase in a refinancing, we do look at your debt to income ratio to make sure that you qualify for the loan. We still do the income check, the assets, just to look at um, your credit profile to see what you qualify for. There's different factors that are involved when it comes to how much you might be able to take out, how much you may be able to buy, how much financing will provide. All that's determined based on not just your credit score, but your credit history, as well as your debt to income ratio.
Okay, so even if mm, y'all guys, I really truly apologize. I have no idea why. There we go. I had to get it all the way out. So that's good information, Mike. And the reason why I wanted to do this talk today, because for so long, for all of these weeks, I've been talking to the individuals that's looking to purchase a home. But
Mm,
now today I wanted to talk to the individuals that have homes, and
mm.
so they can know what benefits that they have. So one another question is, when should a client consider refinancing?
Well, you have to one look and see, make sure you identify the reason, the purpose of you refinancing. What are you trying to get out of it? Because that's what we're going to look at. We're going to make sure that whatever you may be trying to do, we're going to make certain that there's not a risk to you in terms of qualifying for a loan. So, for instance, going back, if you wanted to do some rehab work or get some things done to your house, maybe make an extension on your home, or modify your home. Perhaps you can take out a certain amount of money in order to do that, and we look at different things to see if you do qualify based on the loan to value. That's where the balance of your loan versus how much you own the home is going to dictate how much money and how much financing we'll be able to do. So really, it goes back to, what's the purpose? Why are you trying to do refinance? Some people may not want to take money out. They may just want to do, again, what we call a rate and term and no cash out. Perhaps they're at a 5%, 5.5% interest rate, and their monthly payment is 1,500. And based on today's historical rates,
Mm-hmm.
we may be able to get them to a 2.753% fixed rate, where it's possibly saving them several $100s on their monthly payment.
Okay. Um,
Savings is earning, right? I can I can't hear you.
can you hear me now?
I can hear you now.
What are some of the reasons someone could get denied for a refi?
Um, and that's a good question. This is, the typical answer will probably be because of someone's credit, and that's not necessarily the case. If I go back to the mortgage, what we call the mortgage meltdown back in 2006, seven, when the foreclosure rate really hit, a
Mm-hmm.
lot of that had to do with overvalued homes. Um, People were trying to refinance their homes and they couldn't. They may have had the credit score, they may have had the income to do it, but just the situation at hand that took place, where the values have depreciated, may not allow them to refinance. So it's not just all about maybe somebody's credit, where it's going to deter them from getting a refinance or even buying a home, but it also has to do with the property itself. And again, that's things that we have to look at. Our job, I consider myself not just a mortgage loan officer, but more so an investigator. I got to be able to solve the mystery. I got to be able to put all the pieces together, as I say and preach, and make sure that all the pieces fit in order to determine whether or not you're able to get qualified or you're able to buy a home or refinance a home, if you will.
Okay. So that makes sense for us as realtors when we're even looking for homes for our clients, it's good to look at the history of the neighborhood. Like, with if the properties are the incline, it's more of an incline versus a decline, when you're looking at the value of the home, so that's why
Mm-hmm.
most of the times they say it's good to buy. If you can buy a home with equity already in it, that's perfect. But
Mm-hmm.
if you're buying directly at that equity line, it's good to
Mm-hmm.
pay close attention to the neighborhood to make sure that this neighborhood is up and coming. We're
Mm-hmm.
saying, if anything, the property values are going up versus declining. So that's
Mm-hmm.
good for a realtor to pay attention to as well. Okay.
Sure. So, yep.
Okay. So what happens with your home loan when you refinance? What are the changes? Do you start a whole new loan? What happens to your original loan? What is the process? What happens to this loan when you decide to refinance?
Another great question. A lot of people tend to think that, they may have 10, 15 years left on their mortgage. So sometimes there's hesitation that could actually benefit them, and they just don't know. For instance, going back, I'll stick to the same percentage rate. They may have a 5.5% interest rate. Maybe they have less than 10 years ago, and they can see, with the way the world is run now on with social media and technology and so forth. You don't have to necessarily contact a lender to find out, what's the going market rate. You can actually just go right online and you can see all type of rate advertisements.
Mm-hmm.
So a lot of times, they may have a 5.5 interest rate, but they'll see a 3% interest rate, but they may not want to go through that, even though it can cost them a couple of $100, save them, sorry, a couple of $100 a month. They're thinking that if they refinance and they got less than 10 years left, that the clock is going to start all over again, and which is not the case. They're thinking that they're going to have to start another 30 years over.
So
That's
what
just not the
happens?
case. Well, it's amortized over a 30-year payment, but it doesn't stop the clock. I mean, they continue to take advantage of that lower rate and make those payments. And depending on, of course, anytime you refinance, that's going to add. That's going to increase your balance somewhat because you still have to factor in some closing costs, but it shouldn't be that much where it's going to offset or add that many years to the life of your loan.
Okay.
So, those are things that certainly if somebody wants to call or contact us, we can go over the information. And that's the best way to look at it. As an investigator, um, you got to tell us your story. Let us see what you're trying to do, and we'll look at your personal employment information and then analyze and see what's best for you.
So are you saying if someone, oh goodness, are you saying that if someone has 10 years to go on their mortgage and they paying 5% interest rate, and if they was to refinance, what will they, I mean, I'm sure something happens. I mean, if they don't go all the way to the 30 years, exactly what happens? Do they stick at that 10 years, or do they look at a 15-year with a lower interest rate, or what?
Yeah, that's a good question. I'm sorry. Yeah, and then, the lower, typically, not all the times, but typically the lower your term, the lower your rate could be.
Mhm.
If you go from a 30-year, a 20-year to a 15 to a 10-year, um, you should get a better rate. As far as what rate, that just depends on your credit. A lot of people ask me, well, what type of interest rate can I get? And I'll revert the question back to them. What type of credit do you have? If you got excellent credit, you'll get an excellent rate contingent upon the market. If you got good credit, you'll get a good rate. If you got poor credit, your rate may not be favorable. So,
Mhm.
in terms of, reducing the term of your loan, if you elect to go from a 30, 20-year term to a 10, 15-year, your payment could be lower, but you're going to pay based on the amortization of that term. So, if you spread it on a 10-year term, if you want to do a comparison, you can see your rate is going to be lower, but your payment might be a little higher because you're amortizing it in a shorter period of time versus you spread it on a 30-year, maybe your payment is going to be less, but you're going to have a higher rate. So you got to kind of measure, and each scenario is different. Each person is different, as far as how much you can save versus a 30-year versus a 10-year. All that, you have to take that up with a loan officer, hopefully us at Residential Home Funding.
So this is off. I'm so sorry about this echo, guys. I don't know exactly where it's coming from, but I am having an echo. But this is off. This is off topic, but I'm just going to throw this out there. With the interest rates as low as they are right now, I'm talking to people getting interest rates as low as 2.5%. And like you said, if you were to get a 15%, 15-year mortgage, interest rates could be typically lower. So if you have someone with an excellent credit score and they want a 15-year mortgage and 30-year mortgages are already going at 2.5%, can it go any lower?
Man, you are really asking some good questions.
I'm
Yeah,
just curious, Shit, can I
nah,
have a
you can. Yeah, that's
0.25 interest rate?
yeah. The people calling me, rates, like I said, have been at its historical low points, and people are calling me asking me for zero. I want a 0% rate. Well, so do I. Where can I get it? But
It seems like it's logical.
yeah, but there's what we call a buy down, where you can buy down rates.
Hmm.
There's a cost to that. Is what it is. Is you're buying down. So just like rates, a lot of people don't know this. A lot of lenders don't share this, but just like rates change daily, so does pricing. When we say pricing, the pricing is assessed to the rate. Whether you can get a rate at par means even, that's pretty much free. You get that with no cost. So if today's rate, let's say, was 3.5, and there's no cost associated with it, then that's the rate we can give you at no cost. Now, if you want to go lower than the 3.5% interest rate, and let's say you want to go as low as a 2.25 interest rate, that may be a cost. Each day that price can be different. For instance, it may cost you $6,000 to buy the rate down from 3.5 to 2.25. Some people may say it's not worth it. Others may say it might be, just depending on how many years you got left on the home, how much it's going to save you a month. How fast will you recapture that money that you paid, that $6,000? How many years will it take for you to get that money back? Sometimes it may be advantageous, sometimes it may not be. But again, that's the hands and the eyes and experience of a loan officer who can help you make that decision.
Okay, so are there any closing costs associated with refinancing?
Yeah, there's always closing costs involved in any transaction. So the closing costs for refinancing is minimal. But there are closing costs associated with it.
Okay. Do you have to pay the closing costs up front, or can it be rolled into your loan?
Oh
What?
man, you are really you hitting me with some great questions tonight.
Um,
But this is good. This is good information for those who are watching and who's seeking, because we do believe in promoting and educating to those out there who don't know. But um, yeah, certainly.
you
Uh,
can plead the fifth if you
there,
want. So I know.
no, it just depends on the equity. To be honest with you, um, you mentioned buying down a rate. There's a cost to that. So whether you refinance or buying, if it costs you $6,000 to buy that rate down, you may have to bring that to the table, or you may not. If you're refinancing a home and you got enough equity in the home to cover that closing cost, then there's no cost that you would have to bring to the table.
But that
So
money that you have originally, that money that you would have originally brought to the table, it now rolls over in your loan, correct?
well, yeah. If you're paying if you're rolling it into the loan, of course you're factoring that cost into your payment.
So,
You
but
know,
if you're dropping almost 2% interest rate, but you rolling that $9,000 into that loan, and your monthly payment is cheaper, then like you said, that's when a loan officer, help you with understanding those numbers, and a person make a decision if this is worth it. If this is a decision that they should make.
right. And then you also if you want to go even further for tax purposes, because that's one of the benefits of home ownership, is that you get to write off certain things such as uh, taxes, interest, prepay, that you can use for your tax benefits. So, you want to, if you really want to weigh in and see how much you're going to save for that period of time of the life of the loan, and you really want to measure what's best for you, you also probably want to consult with your tax person as well.
Okay. So when you refinance, it's almost like you purchasing a house over again, and you get those tax advantages.
Say it again. I'm sorry.
When you refinance, it's almost like you're purchasing a house all over again, and you get those tax advantages.
Well, it's not necessarily. It's not like you're starting all over again, but those are benefits. With when you buy a house, of course, as soon as you buy a house, you're in a position after that year when your taxes are due and you do your filings, you certainly can take advantage of uh, the taxes and the interest that you pay on the mortgage, whether you refinance or not. At the end of the year, you're still able to, uh, do some depreciation.
Okay.
Mhm.
So I know we're going a little like deep, and that's why we probably not getting that much feedback, but I know people are going to watch this at a later date. However, you guys, this is really some good information for those that are current homeowners, that are looking for ways to maximize on your current home loan. It rather is refinancing, taking out a home equity line of credit. There's a lot of things that you can do to help you and your family with your home. Those are some of the benefits of being a homeowner, being able to tap into some of that equity, for college, or, home repairs, or debt consolidation. There's a number of things that you can do when it comes to having your home, because as you're paying your mortgage, you're investing into not only you, you're investing into your family and into your future. So as you're paying this mortgage payment, if anything was to come down the line that you needed to be able to pull out of your house, there's a possibility that you could do that. And that's what me and Mike Carolina is talking about right now. Just ways that you can make your house work for you. It's not always just about being that first time home buyer, or upgrading that home, or downgrading that home. There's a lot of things that you can take advantage of as a homeowner while you are in your home. And those are some of the things that we're talking about today. Okay, Mike. So we talked about refinancing. Um, I got a couple of more questions about refinancing, and then I want to get into a little bit. I ain't gonna hold you too long, but I want to get a little bit into the HELOCs and the HELOCs. What is that? The home equity line
Home
of
equity
credit.
line of
Yes.
credit. Yeah.
So, real quick, yes or no questions. These are kind of quick. Do you need an appraisal for when you're refinancing?
That depends. If you're doing a purchase, yes, you always need to have an appraisal done. That's for the interest and protection for yourself as well as us as a lender. We're not going to finance a house uh, more than not more than what it's worth.
Mm-hmm.
So, appraisal has to be done. We got to make sure that the value supports the purchase price. When it comes to refinancing, whether it's a rate term or cash out, more than likely appraisal has to be done as well, unless you're doing which is called a streamline appraisal, where you don't have to have an appraisal. You just have to meet other score requirements such as credit scores and your debt to income ratio has to meet. So,
Okay.
you know, we have to take a look and see if someone was interested in that. A lot of times, um, when the Obama administration came out, they had the HARP loans, and that gave an opportunity to allow people to refinance even when their house was underwater. So I think that was a good thing, and I'm not sure if it's still around or not, but there are other types of products out there that you might be able to refinance without having to do an appraisal.
Okay. I think you talked about the different types of refinance options available. Um, Before I go to the pros and cons, I want you to talk a little bit about the home equity line of credit.
And a home equity line of credit is another option. It's a excuse me. It's a second lien position. Those are riskier loans. A lot of people think, well, I'll do a home equity line of credit. Maybe they're looking to get 25, 30,000 out. Of course, appraisal would have to be done to make sure that there is enough equity to carry over to support the second lien position. So a lot of people think, well, if it's $25,000, I should be able to qualify for that. But the opposite end of that is that those loans are much more stringent because they're at a greater risk because they are in a second lien position. So typically, home equity line of credits, um, uh, they require a higher credit score. Uh, typically, you may be looking at a 680, 700 credit score in order for you to even consider taking out just a $25,000 line of credit. And then they have the limitations as far as how much money you can take out based on the loan, they call the combined loan to value. And that's including the first and second mortgage. Um, there's, a lot of people and lenders uh, really don't express or share this, but there's a home line of credit and there's a uh, HELOC. There's a HELOC and there's a
Mm-hmm.
HELOC. The HELOC is a line of credit that you use almost like a credit card. You only pay on what you use. And
Mm-hmm.
then there's a HELOC, which is more, they give you that if you wanted to get $30,000, they'll give it to you all at once. So it's not a line of credit. They're giving you that entire amount at one time. So it just depends on how you want to utilize that money. Just depends on if you want to try to qualify or obtain a HELOC versus a HELOC.
Yeah, I like the idea of the HELOC.
Most, and that's a common. If anyone were interested in doing second liens, that would be the common way to go. They're not as popular as they were going back into the 2007 and 2008 years when we were doing a lot of purchases. Um, and we're doing 100% financing actually, where we'll split an 80-20 loan. So you won't get hit with the mortgage insurance. And so the way of doing that, you can eliminate mortgage insurance if your loan to value was 80%. So we will split the two. So you get 100%, what it means when I say 100%, people think, oh, I don't have to pay any money. No, we're talking about 100% down payment. There's still closing costs involved. So the thing is, as you know, people, that's kind of a misconception, or people really don't understand. When we say 100% financing, it's for the down payment. There's still closing costs involved, and down payment is part of your closing costs. But in terms of a down payment itself, back then, we'll do an 80-20, and you add those up, that's 100% to avoid the mortgage insurance. So you pay on that 80% loan, then you have a second lien position where you pay a minimum amount on that 20%.
So I'm glad you said that because I never understood why or what made them decide rather you get a 80-20 loan or a regular loan. And I do remember, like you said, kind of back in the day, most people used to say, I got an 80-20 loan, two
Right,
mortgage, but you paid two different people. So now I see
right,
why that's done to prevent that mortgage
right,
involvement. So it makes sense. So I just
exactly.
want to cut in real quick because I just want everybody to know that is either watching now or that's watching a replay. Although Mike and I are talking about refinancing and home equity lines of credit and he loans and all of that stuff. Mike is a lender, a well-rounded lender. He not only work with refinancing, he also work with new purchases. So I do want you guys to know that Mike is a lender that works with all types of loans. I just decided that I wanted to do something different today and talk more about refinancing and home equity line of credits, just to give some of my folks some knowledge that have homes and want to know more about refinancing because it's really big right now. Everybody's asking about refinancing because the interest rates are at record lows. So I wanted Mike to come in and kind of talk about that. So for you guys that's just coming on, he talked about based on your credit score is where your interest rate can be right now. So if you have excellent credit, you could get an excellent rate. When I say excellent rate, I mean they're giving out rates now as low as 2%. So if you guys are in a good position and have excellent credit scores and have low debt to income ratio, and you're looking to be able to refinance your house, even if you don't want to pull no money out, just to be able to get that lower interest rate is something that you should really think about. I just recently refinanced not too long ago, lowered my interest rate up to 3 something%, and my mortgage went down $200. So I want everyone to look into different options to make sure that you are making sure that your investments work for you. So that's why me and Mike are here talking about refinancing, talking about HELOCs. I really want a HELOC. That's why I always ask him about that. He said that they are really hard to get sometimes, but I really want to be able to get it to just have it. And like you said, with HELOCs, it's at home equity line of credit. So even if I was to use $10,000, as I'm paying that $10,000 back, it's being replenished. It's like a line of credit. So I think
Right.
that that's something, if you guys don't know about the HELOCs, it's something that you really should educate yourself on, because I really think it's beneficial. I mean, you just never know when, like how they always say, have that one major credit card. Shoot, my one major credit card would be my and that thing could just be, making it work.
That's right. Yeah, yeah, yeah. So good points, Ida. Really appreciate this time and reaching out to those who may need our services or who just want to be educated. And I will extend that. Yeah, we offer different products, programs. We do refis, we do purchases. We also are a commercial lender. We're direct lenders, so that means a lot of times people ask, "Are you a direct lender?" Half the time, those people asking really don't know what it means. But just for those, for purpose sake, direct lender meaning we have our own warehouse line, we have our own funds that we use to close. We have our own underwriters and processors in house. We're not a third party or broker, so everything is controlled within. So I think that's important. I think that's an advantage that we have. Of course, we're licensed in many states. Of course, most of our target area is in the Maryland, DC, Virginia area, but we pretty much are licensed all the way up top to all the way down south to Florida, Texas, and California. We also do reverse mortgages. We do land transactions. So any type of mortgage financing, we do. And if you're interested in some of our products and programs, we'll of course believe either we'll have another time that we'll be on this platform to talk about various different products and programs that we have, such as our grant program. I won't tease y'all with that, but we offer 2 to 6%. Actually, I will tease you about. We have
I was going to ask you that. Are
we
you
have
guys?
we have between 2 to 6% grant money that we're giving towards closing costs, not only towards closing costs, towards down payment, which is huge, especially with FHA loans. Typically, FHA, they require you 3.5% of your own money or a gift. Well, that grant money can be applied towards your down payment as well. In addition to, you can still get seller's concession. And the other great thing about it is just not for first time home buyers. This is for any buyers that can qualify for this grant program. So if you're interested in that, you want to learn more, of course, we'll have our contact information there and we can discuss more in detail.
Okay, Mike, since you brought it up, I need to know. Okay, so you guys still have in-house financing going on. What are the credit scores for your programs, your grant programs that you just shared?
Well, we go as low as 620 on the grant programs.
Hmm.
That's one of the qualifications. There's really only a few qualifications for the grant program, and it's real simple. You have to have a minimum of a 620 credit score. Your debt to income ratio cannot exceed above 50%. That's if you have a 660 credit score. If you have a 640, between a 620 and a 659 credit score, your debt to income ratio can't be more than 45%. The other factor that you have to qualify for, that is a requirement, is that you have to take a home buyer's education course. You can do that online. You call us. Typically, they're about $25, $35. We have a partner where it's free, and you can go on there, and it takes you about 20, 30 minutes to complete it, and you'll get your certification right then and there.
So
And it has to be a primary residence. So, again, we can go more in detail if anyone is interested in those grant programs. I think, Ida, that we have the self-employment programs for those who are having a hard time getting qualified for loans because their taxes, the net doesn't meet the loan amount or support the loan amount. So, for instance, if you made $150,000 a year, yeah, you made some good income, but then with all the write-offs and the depreciation, it shows that your bottom line may be 40,000. Well, unfortunately, we're going to have to go off of that 40,000, which may not allow you to buy a $300,000 or $400,000 home. So in substitute of that, we don't ask for tax returns because we have a bank statement program that we'll use as income. So we'll look at your average deposits for 12 months, anywhere between 12 to 24 months, depending on your credit score. So if your average deposit is $10,000 a month in a 12-year period, then 10 times 12, that's $120,000 that we'll use as your income to help you to support you in that loan. So
okay.
again, that's just some of the programs that we have, but we'll talk about that probably, I'm sure, in another session.
I mean, you getting started, but no, we got another question.
Okay.
How long should you be in your house to refinance or to lower your interest rate? Not to pull out, but to lower your interest rate. How long can you refinance after you purchase your house? I guess that's the question.
to refinance it.
Yes, to refinance for a lower interest rate. So do you have to be in your house for 6 months? Do you have to be in your house for 12 months? Can you refinance after 2 months?
Well, typically it's after typically it's after 6 months. Um, that's the average, but I believe you can refinance sooner than that. It's a case by case scenario, but
Okay.
typically six months.
Okay. All right. Boy, you start getting into I wasn't trying to
I
hold
know
you
we're
that
not
long, but I'm
ready.
not even going, but you started opening up
I
doors.
saw I know a can of worms, huh?
So are you guys still doing? I mean, I know a lot of lenders have fell back on offering those loans for self-employed individuals. Are you guys now back
We are everything that I'm telling you live action.
Hey,
We're doing right now. Tomorrow can change. We don't know, but as of today, we still have those bank statement programs. As of today, I will say with confidence and assurance that we are doing. Most lenders these days, because of unfortunately COVID-19, which I hope everyone is taking care of themselves and being safe and really taking this seriously, especially during the times of, all the racial tension going on. Still got to be mindful of being safe out there. But even as of today, we're one or only a few lenders who are actually going as low as a 580 credit score to do a FHA loan with 96.5% financing. That's strong. Most lenders, and you can do your research, do your due diligence. Most lenders, you have to have at least a 640, 660 credit score. Even for VA loans, typically you have to have a 660, 680 credit score. Where we're right now, as of today, we're doing VA loans with a minimum score of 620.
okay.
So, anyone again who's interested, it may not apply for everyone, but those requirements and we still have available to possibly and hopefully get you into a mortgage loan, whether it's a purchase or a refinance.
So
Just give us a call. You got our information, and we'll be sure to at least take care of you, educate you. We don't make any promises. We don't make any commitments until we evaluate you. You basically, a lot of people look at lenders. I won't say as a bad guy. We have to protect our interests as well. But it's you, what you bring to the table is going to determine if you're able to get qualified. So, if, if you're really interested and I'll say especially for purchasing, make sure you have your house in order. When I say your house in order, I mean your credit. If you want to buy a house, be serious about it. Make sure you're in that credit. You're in that good credit position, because the higher your credit, the better your rate, the lower your payment, the more money you said. Ida, you just said you just refinanced your home. You saved a couple of $100 a month. So if you factor a couple of hundred times 12, that's what, $2,400 that you done save for that year. You times that by 10 years, that's $24,000 that you done save. Saving is earning. So, that's equity that you're building into your home. And I like what you said. This can become, buying a home, generational wealth, not just for yourself. You can pass it on to your loved ones. So, and that's what it's all about, so. Um,
I'm sorry, guys, for my connection. This is the first that this has really happened with all of this static. But I just want to clarify really quick why I got you on the line, right? Because I know that you guys have a lot of your own grant programs, in-house programs, and I know that the Home Partners of America, not Home Partners of America, and not even the Merlin Mortgage Program, but the other one, the PG County loan. You know what I'm talking about?
you're talking about not my home. Is it my home?
No, no.
Because my home is.
So it's a
Yeah.
great, it's a program that helps you with down payment and closing cost assistance. I think that they're experiencing some issues right now with the inspections because with those programs they have a lot of extra stuff that goes on with those programs.
Mm.
I just wanted to know if I have a client that, like you said, is under 55% that DTI or maybe close, but you can also always rescore them, right? Or like have them to pay down certain things to get under that DTI, correct?
That is absolutely correct. We have when we pull your credit, we analyze your whole profile. We find ways. Um, we don't charge points, which I think is huge when we look at other competitors because someone's charging you points. When I say points, there's a certain percentage they may charge you. Typically, that can be anywhere between 1 to 2% that they're charging. So if you talk about a $300,000 or $200,000 loan, 2% of that, 2% of a $300,000, $6,000 that you would have to bring to the table in addition to your other closing costs. You're not just paying that one time. You're paying that 6,000 on a life of the loan because that's built into your loan. So we don't charge. We don't charge points. And I'm sorry, what I got off track with.
Do that affect the amount that they're getting approved for? Using you guys in-house program, if they were to use your in-house program, does it affect how much they could get approved for, or no? Like, say for an example, if they went through Maryland Mortgage Program and they were approved for $340,000, I'm just throwing a number out there, but then they went through your program, which, like you said, you have in-house grant programs, 100% financing. Does that affect how much loan you could get approved for based on the
Yeah,
grant?
because there's a cap in terms of not just the financing for the loan, but also you got to account for the financing for the grant. So if the grant is capped, if your DTI is capped at 45%, then that may enable you to or disable you to buying perhaps instead of you trying to buy a $350,000 house, maybe you had to downsize to a $325,000 house. Of course, that's contingent upon the sales price as well as the taxes, or if you have any condo fees or home owners association fees. All those determine what your total monthly payment will be. So we had to take all that into consideration to see exactly what you can afford and then determine that tolerance between what you can afford and what's allowed when you taking looking at the guidelines for the grant programs. But going back to, and I'm sorry, I got a little off track. Going back, you mentioned the credit. Yeah, we pull credit, we evaluate your credit. So if we can see where we can uplift your scores for, maybe another 5 to 20 points. That's going to get you a better rate and get you more financing. We're going to discuss that, and myself as well as our loan officers, they'll evaluate and we'll tell. We're able to see actually when we pull the credit how many points we can increase your score right then and there between each of the three credit bureaus, Experian, TransUnion, and Equifax. So I know a lot of people are using these um, credit counselors, and not to speak bad on it. I mean, it's good if you got some real deep things going on with your credit. You might need some counseling with your credit, but we do that as well. And right there, when we pull the credit, it'll tell us how we can impact your credit scores. I mean, a prime example, I had a client just last week. She had a 549 credit score and middle score, where she had, I think her low score was 540, and her high score was 600. Well, we needed that 580 credit score. We were able to turn that 549 credit score to a 587 credit score, which allowed her to qualify for a loan. And it showed us how, and this was a matter of 3 or 4 days. It'll tell you what exactly you need to do in order to heighten your score. You just got to follow it, but it certainly can be done. It's certainly attainable.
Okay. Did you do that for average people? Could you do that for me? It's like, no, I'm just.
I do it for everyone. So, some people, I know people who have 780 credit scores and, they think that, that's not high enough. And, they want to brag and boast and say, how do I get to an 800 credit score? Well, let's look and see. Maybe you got too much credit. Maybe you need to, bring your balance down some. So again, to each his own, we evaluate every situation.
Okay. But thank you so much, Mike. And thank you, Elena. She said this is some good information and thanks for sharing on the platform. I really, really appreciate this. You started getting into the juicy stuff towards the end. I know a lot of people might feel like that refinance information was a little bit dry, but I just wanted to give that information for us existing homeowners because I want us to know that just because you have you're in your home, there's still options for you to take advantage of these lower interest rates and even take advantage of some of the equity that's in your home if you have to. So Mike just wanted to give us some extra little stuff towards the end. So I really appreciate that. I am going to have him back on, y'all. Excuse me. This is a disclaimer that my grandson is here and he's, yes, baby. Who's that? That was Papa. He was leaving. Watch out for 1 second, okay? I'm sorry, guys. So look, I'm going to have him back and we're going to just dive in to a few things. Take some time to follow him on social media. Follow him on Facebook because soon I think he's going to start Mortgage Tips Mondays and just give you guys a lot of different good information.
Monday Mortgage Talks. Yeah, we're going to begin that probably within a week or so. And, it's more information out there to give you. This is just kind of a taste, but there's a continuation of what we have in store to provide and help you all to understand, the mortgage needs that one may have.
Okay. All right. Well, thank you, Mike. I know. That's my little light bright grandbaby. But thank you, Mike.
Okay. No problem. I appreciate you as always. This was good, and hopefully somebody's able to gain some information. And whoever's in need, like I said, my contact information will be provided. And okay, good. And again, it's always a pleasure, and I know we'll be talking soon.
All right. Thanks, guys, for joining us. Have a good evening. See you next Wednesday. I don't know what the topic is going to be next Wednesday, but of course, I come every Wednesday to just share some tips about generational wealth, real estate, side hustles, a little bit of everything. And tonight we were talking with Mike Carolina. He's the branch manager with Residential Home Funding, Team Carolina. I thank you guys so much for joining us. My name is Ida Robinson, and I am a real estate agent, licensed in Maryland, working on my DC license. So if you guys have any real estate needs, please give me a call, contact me, hit me in my DM, anything. Mike, you got all of his information there. Follow him on social media. And we will see you guys next time.
All righty. Thanks a lot. You all take care. All right.
Yeah.